Pfizer is currently at its 52-week low, trading in the $25 region. So is it a strong undervalued buy now with a yield of 6.32%? We're going to take a look at the updated numbers, a lot of new information, some surprising numbers as well on both the top line, bottom line. We'll also look at the company's health, their balance sheet, cash versus total debt. We're also going to talk about how they've performed over the last few years against some of their competitors. We'll discuss some insider buying that we have noted over the last few months, and we'll look towards the institutions if they are still buying quarter on quarter this company, which continues to be in a downtrend. And as always, we'll look at that dividend safety, which gets higher and higher as the weeks go by. We'll look at the financial metrics as well to see if they support a strong case for a buy. And as always, we'll run them through the valuation model, getting to the intrinsic value, looking at that acceptable buy price with the investor margin of safety, and see what Wall Street are targeting for the next 12 months. So firstly, let's just take a quick look at this company. It is down around 2.5% just today, down 36% over the last year, and over the last 10 years down 16%. Now these numbers don't include those dividends reinvested, but they are still very, very poor and quite some way away now from their all-time highs at the back end of 2021 at around $60. As we mentioned, right there at their 52-week low, a yield of 6.32 forward-looking and a forward P now just under 12. Now with their latest earnings, let's take a look at those numbers on the top line. Total revenue, $41 billion in December 2019. Remember the target here, at least 3 to 7% year on year for steady moderate growth. 2023, $58 billion. Now, just looking at this from a non-granular view, what we can see is that the top line has increased by around 50% over the last 5 years, which is fairly positive, but the truer picture is taking a more granular level look. We see it pretty flat from December 2019 to 2020. The pandemic hit, their top line doubled, and then we can see that also helped increase their revenue into 2022, going up to $100 billion. Now, from December 2022, from that latest annual earnings, we see it has dropped significantly by over 40% from $100 billion to $58 billion. So a little bit of a cause for concern there. We do see it drop quite significantly after that pandemic. And we can see on their bottom line, it has gone from $16 billion down to $2 billion. So on that granular level as well, we can see it decreased into 2020, increased all the way to 2022, and then decreased to 2023. Just a bit of a red flag indicator given their top line has increased, yet their bottom line net income has decreased very, very rapidly. So a little bit of a warning sign there. Again, we can touch upon that soon. Quick health check then, total cash versus total debt. It has increased from around $9.7 billion in 2019 to around 12.7 in that latest report. But we do know it did increase very rapidly when they did have that COVID boom to around 31 billion, and since then it has been coming down. Nonetheless, still a fairly healthy cash balance. In comparison to their total debt numerically and directionally, what we can see, it has increased from 53 billion to 75 billion. So whilst their cash has increased very slightly, their total debt has increased very rapidly, and this will be important when we come to look at that dividend safety as well as that net debt to EBITDA metric. Now, very briefly, competitors in the pharmaceutical industry, we have Bristol Myers Squibb, AstraZeneca and a few others. Now, no surprises here, Pfizer down around 32%, the worst performing, and bear in mind that does include those dividends reinvested. When we extend that to the last 5 years, again we see Pfizer as the worst, negative 23% over that 5-year performance. But as I always mention, and it is important to understand, past performance is not an indicator of future performance. So always bear that in mind. On the channel, we do typically look at the insider buying and selling. So we have buys and sells, minimum 100 shares over the last 3 months. And we can see what I consider to be a bullish signal. The director, Scott, as we can see here, did buy around 3,000 worth of shares at around midpoint of December 2023 for around $80,000. Now, the share price since then has dropped by around 2%. But the main key takeaway from here is that insider buying is something that we do consider to be bullish. The reason for this is that insiders buy for one reason only, and that is because they think the price will rise. So a fairly positive sign, although do bear in mind this was around 3 months ago. In terms of institutional ownership, well, that now sits at 68%. around 12 billion worth of sales by these institutions over the last 12 months. The same period, 86 billion worth of buys, so a lot more buying than selling over this period. And on top of that, in the latest quarter, Q4, we see more buying. So not just over the last 12 months, but also in the more recent quarter. Again, do bear in mind with this information, always do your own due diligence and never blindly follow the institutions. Now, before we talk about the dividend safety, just to let you know, we have released our latest free weekly article. If you want to gain access to this as well as all the other articles we have completely free, just click on that pinned comment below. Pfizer dividend safety then score sits at 75. It does look to be safe. Market cap 150 billion. It is a mega cap company. In terms of those recessionary metrics, well, they cut the dividend during the last recession, negative 6% recession sales, but that was above the average growth of companies in the S&P, which was negative 12. It also marginally outperformed the S&P, negative 45% return versus the S&P's negative 55. Dividend growth pretty poor last December, 2.4%, below the 4% we advocate on the channel just to keep up in line with inflation, but we do see on average over the last 4 years, or 5 years in fact, and over the last 20 years, they have at least managed to keep up with that inflation. And bear in mind, you are getting a nice starting yield of 6.3%. Now, they have been increasing those dividends for the last 13 years, which is fairly positive. It is what you want to see, a lot of years of consecutive increases. And on that dividend yield theory, which for new viewers, it shows a company is undervalued when the current yield sits above the 5-year average, we have a sign here of undervaluation. On the forward PE, 11.7, showing us a sign of reasonable valuation given the rolling 5-year average of 12. But as always with these models, we don't look at any of them in isolation, and we conclude towards the end. Healthcare sector PE is also much higher at 17.3. So in terms of the free cash flow payout, and again, we're going to show now why it is very important to look at the free cash flow. Earnings, it is susceptible to manipulation by management through accounting. Now, one example of this here is essentially that in 2023, management paid out more in dividends than they generated in free cash flow. We can see this 193%. Quite a bit of a red flag indicator in my opinion, something you wouldn't be able to derive if you looked at the earnings payout. What I quite like to see is a blanket rule of 60% or lower, as this gives me faith that management are able to offer those double-digit dividend increases we love to see. Now, another red flag indicator, 2024, they are still expecting this to be over 120%. Now, I hate to be someone who's very negative, but just consider there is that possibility of a dividend cut if they are continuing to pay out more in dividends than they're generating in free cash flow. Free cash flow per share as well, we'll talk about this when looking at the valuation model as well, but we can see whilst it increased from 244 to 464 in 2022, it has dropped massively in 2023 to 85 cents. And even in 2024, when they are expecting an increase, that is still much lower than over the last 10 years. So a lot of warning signs here, just things to understand as an investor. It doesn't necessarily mean this is an uninvestable company. What it means is just bear this in mind when you are calculating your margin of safety and looking at your investment thesis. Sales growth, now steady moderate growth, 3 to 7%. Let's be honest, from 2014 to 2020, before the pandemic, for Pfizer, their top line growth was abysmal. 2021, 2022, we see that impact of COVID. Their top line increased very strongly. 2023, now we see negative 42%. That is a big worry in my opinion, whether or not they can essentially sustain some nice revenue growth even after 2023 and beyond, at least at that 3 to 7% level. Numerically speaking, we see it go from 50 billion to around 59 over the last 10 years. What they are doing is returning that excess cash to investor pockets through share buybacks. They have reduced accounts, not very consistently, but nonetheless reducing it from 6.42 billion to 5.71. Now, in terms of the return on invested capital, I want to see 10% or more, just because for me that number gives me faith that management are able to effectively allocate their capital. 2014 to 2020 looking fairly solid, very inconsistent nonetheless for the majority of those years above 10%. 2023 dropped down to 3%, a bit of a worry in my opinion, something just to bear in mind. We do want to see 10% really as a minimum, so do consider that. Operating margin, again, up to 2022, looking very positive. We want it above 12% ideally for the majority of companies. We see it dip to 9% for Pfizer in 2023. The same could be said for the free cash flow margin. It does dip. Now, the 8% is still above that 5% level we like to see, but it has gone down very sharply from 2022's number. So again, these are things you just need to consider. Net debt to EBITDA then, Earnings before interest, tax, depreciation, amortization. Remember, this shows us two things. One, that dividend safety, and secondly, the balance sheet strength. Now, 2023, 4.94. This is the number of years it would take Pfizer to pay off all of their debt net of cash on hand. We want below 3. Now, 4.94 is very high. The positive here is that it is expected to come down to 2.97 in 2024, but if they continue to pay out more in dividends than they generate in free cash flow, and they have a very high debt level, this is a question mark in terms of that dividend safety. Just something to consider. For now, it does look to be safe, but these are things you do need to be thinking about. So let's jump into the valuation model of Pfizer. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, let's jump into the first model. We would typically use this as Graham's valuation. However, their earnings per share, we want to point out, has dropped massively down to 37 cents in the latest trailing 12 months figure. So this one becomes obsolete. And therefore, likewise with the multiples valuation model where we use companies in a similar sector and size, we're not able to use this. Otherwise, it will pull out numbers like $1 or $2. So we can really only use two models. So the first one is the discounted cash flow model. So we can see here we have put the free cash flow year on year for Pfizer. Now, a few things to note that we want to point out. Firstly, 2022, we do see that essential free cash flow drop massively into 2023, 4793. So what we've done for our starting point in 2024 is we have used the number that management are expecting. From that, we have gone for a growth rate of 8%. Now, you could consider this optimistic, you could consider this pessimistic, or looking appropriate. Again, if you grab a copy of the model in the pinned comment below, you can run your own estimates through. Based on this number, then, we get the present value of future free cash flows and terminal value. If we add the cash, subtract total debt, get to the equity value, divide by the shares outstanding, we get an intrinsic value showing $25.30, which is pretty much around the current value. So while we have undervalued due to the slight difference, we would say reasonable valuation. We then get to the dividend discount model where we have the dividends year on year. Now, the more recent increases have been around 2.5%. Average of 3.14. We have gone forward looking around that average, and that gives us an intrinsic value of around $36. So we have a real sign here of undervaluation. So the intrinsic model for Pfizer in today's episode is the average of these two models, and we get to a value of $31. Now, in terms of the current price around $25, we always start with a margin of safety around 10%, and this is what we use if we believe companies meet three criteria: a wide moat, strong financial metrics, and good forward-looking data. So we keep going until it's near the current trading price to understand what level of margin of safety we're at. So right now, a 20% margin of safety would be around $24.73. So for Pfizer, we see between 15 to 20% margin of safety at the current value. In terms of Wall Street and their expectations, well, over the next 12 months, they see a lot of upside, just under $32 as a price target, 28% upside, so they do consider this to be a very strong buy now. As always, though, I'm interested to hear your thoughts, given how far those metrics have fallen off from 2022 to 23 and 24. There is some cause for concern. That's something you should just consider in your thesis. Now, use your margin of safety, whether you want 10%, 20 or 30%. Understand what you are buying, understand the projections and their historical performance. And in fact, one thing that I would say that is key with Pfizer is how well they had performed before COVID. And by well, I'm saying how poor they had performed and those metrics we had run through. As always, though, let me know your thoughts in the comments. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you on the next one.